Okay, hi everyone. This is going to be the second lecture for chapter 9. So we're picking it up here. We looked at those kind of limitations on business expenses. Now we're going to start talking about accounting periods and kind of other sort of frameworks and considerations when we talk about cash and accrual basis tax accounting. Okay, so we talked about business income. It's generally going to be like gross income from like all sources, usually like what the business is for, right? We're selling our goods, we're providing our services. We talked about expenses. We said they had to be ordinary and necessary. We talked about caveats to those expenses when you don't get them. The next thing is once you figure out your income and your expenses, you got to say, okay, what is the period in which we're recognizing these income and deductions, right? What is our tax year where we're going to report them for? And in this way, right, when we have a tax year, you can have a full tax year or a short tax year. What does this mean? Well, a full tax year is, hey, we were in business this entire year. We're recording all of our income and expenses from, for example, January 1st to 12/31. Okay. In distinction, you can have a short tax year. And what that means is that's really in the first or last year of business. So, hey, we only started this company in March, right? So, hey, our first year is going to be a short tax year, right? We only have like 8 months or 9 months of income to report. It's not all 12 months. On the flip side, when we close the business, right? Maybe we shut down shop, it goes out of business in February, 5 years later, right? Well, that would also be a short tax year because we only have 2 months of income and expenses, right? We went out of business. It's not all 12 months, okay? So that's the idea. A full tax year, a short tax year. We're figuring out what is the period over which we're reporting these sort of income and expenses. And generally, with tax years, another way you can categorize them is a tax year end can be a calendar year end, 12/31. It can be a fiscal year end, any time other than 12/31, or it can be this 52/53 week year end, which is kind of a modified version there. You can read that. So that's the idea here is we're trying to figure out the accounting period. And the idea overall here, as I have, is not all tax years are available to all taxpayers. You don't kind of always get to pick exactly what you want. Let me get this thing off the screen just to have it clear for you guys there. So, as a general rule, if you're a sole proprietor, right, you have that Schedule C, you're self-employed, you're going to use a calendar year end, right, whatever, your tax year end, 12/31 is going to be the business's tax year end. Similar framework there for partnerships and flow through entities, S corps. General rule is going to be the tax year end of their owners. Most of the time, right, the owners are individuals, so that means we're going to have a calendar year end. And then C corps, right, they can elect a fiscal year end, a calendar year end, or a 52/53 week year end. Okay. So we said, income expenses, we got to figure out the tax year. Then we're saying, okay, once we know that period of time, we have to determine the items to recognize in that time period. In other words, what methods are we using to capture and report our income and deductions, right? What is kind of the overall idea here? Are we going to be more of an accrual basis taxpayer or a cash basis taxpayer? And that's really what's going on here. So a couple things to kind of backtrack. If you think about financial reporting, right, like your like intermediate classes, stuff like that, the name of the game, the goal there is you really want to kind of puff up that income on the books, right? You want the most income so your shareholders will love that. Tax, however, sort of is the reverse, right? We want to have minimum income because the more income we have, the more tax we owe. So you can see there's kind of a tension there between what you have on your books and what you have on your tax return. And when we talk about the tax return, right, when we talk about the methods we're using, there's generally going to be an overall method, right? Like, what's the overall thing you're doing? Are you going to be cash method or accrual for tax? And then for specific items, right, we will kind of have specific methods, right? So the general rule here for a cash method taxpayer, and there will be modifications to these, is that you recognize, put on the tax return, income whenever you get cash, and you recognize an expense anytime you pay cash. In distinction, for an accrual method taxpayer, the general rule is going to be that you recognize the income when you earn it, and you recognize an expense when you incur it. Okay, so that's the difference between accrual and cash. Businesses can, for this overall method, generally businesses are free to choose. However, if you're a large taxpayer, right, remember that gross receipts test, you must use the accrual method. You don't have a choice, right? So if you work at a big four firm and your clients are all giant, right, most of them, those tax returns, they're all using accrual methods. So that's like one kind of headache for those bigger businesses. They must use accrual on the tax return. Okay, so talk a little bit about the cash basis for tax. As we said, right, the general rule is going to be you recognize revenue whenever you receive the cash or property or services, right, actually or constructively. And expenses, you're generally going to recognize them when you pay the cash, okay? Now, there are kind of some things here to be aware of. So as I have in certain circumstances, a business expending cash on a business expense may not be allowed to currently deduct at the time of payment, right? So what's going on here is, yes, right, you can generally, and what you're going to do there is expense cash, right, as it's an outflow, but you don't always do that, right? Where we're going with this here, right? Whenever you have, as I have, cash method taxpayers are not allowed to deduct expenditures that create future benefits. In other words, that's just saying, hey, yeah, generally whenever you spend cash, that's an expense, but if you buy stuff where you have kind of long-lived items or prepaid expenses here, right, you have to capitalize them. But there's an exception to that, right? So that can be a headache if you have to capitalize stuff. Sometimes small taxpayers, right, it's just easier for them to expense it. So the IRS has come up with this 12-month rule, right? And the 12-month rule says this: when a cash method taxpayer prepays a business expense, it may immediately deduct that expense if the contract period does not last more than 1 year and the contract period does not extend beyond the end of the taxable year following the tax year in which the taxpayer makes the payment. Right, so let's look at example 915 here to give this some numbers. That is a mouthful. What is going on here? Right, so let me back this up to 915. We're talking about the kind of level set here, right? A cash basis taxpayer. And we're looking at expenses, right? We said what's going on here is generally you're going to have an expense whenever you pay the cash, right? But, right, we have an exception that says you have to capitalize prepaid expenses, right? Like prepaid rent, things like that, prepaid insurance. But we have an exception to the exception, which is this 12-month rule, right? So let's look at this over here, right? On July 1st, year one, a taxpayer pays $1,200 for a insurance policy. Right, here we go. We pay $1,200. The policy term is from July 1st through June 30th, right? So it's this guy right here. It's 1 year. How much of the $12,000 expense can they deduct if it's the cash method? Well, the idea here is we're going to kind of snake our way through that logic chain, and we'll be able to use the 12-month rule to immediately expense this. Specifically, right? It's a prepaid expense. The insurance period, that green arrow, doesn't exceed 12 months, and it does not extend beyond the end of the next tax year, right? Here's year 1, here's year 2. We're not going into year 3 there at all. Let's look at example 2 and example 3. So they're kind of giving us a similar fact set, but what they're changing here is the policy term, right? It's running in year 2 from there to there. So you would think, right, well, can we use the 12-month rule? No, this fails one of the tests, right? The contract period here goes into year 3. All right, you see that? So, we fail the 12-month test, which lets us expense it. So if we fail that test, then we must capitalize it, right? So that's what's going on here. Example 3, same facts except 18-month policy. Right, so the idea with this is, we don't go into year 3, but the contract period is for 18 months. That's going to be more than 12 months for the 12-month rule. So accordingly, right, what they're saying here is we can only deduct to the extent, right, we actually incurred it there, the $400, okay? So this is kind of showing you some variations on that. All right, let's move to the accrual method, right? So from sort of a very, very high level, right? It's like you accrue the revenue whenever you earn it. You recognize the expenses when you incur it. Now for tax, they have a little bit more specific here, right? So as I have here, taxpayers generally follow GAAP rules, but they recognize income under the accrual method when they meet the all events test, right? And this is for income. There'll be a separate all events test for deductions, but it says here, the all events test basically says when you earn it, right? That is to say, when all events have occurred that determine that or fix the right to receive the income, and the amount of income can be determined with reasonable accuracy. So it's when you earn it, but it's also fixed. We know what we're getting into. So let's look here at 916. Okay, so we have a taxpayer who does work for clients in December year 1, but they receive payment in January year 2. When do they recognize the income? Right, so if it's an accrual basis, right, then the year 1, they're going to recognize it here, right? The idea for that is the right to the income is fixed and the work was completed. We met that all events test for income, right? So we include the income here for accrual. If we were cash basis, however, right, we don't get paid until year 2. So we would only recognize that in year 2 for cash basis. All right, so we're going to do some more examples like that where we compare the two. So as we have here, right, a couple other things. Let's talk about unearned income, right, advance payments. So hey, we're a landlord or we're a business. We have a client or somebody who pays us before we provide the services, right? So as I have here, accrual methods, taxpayers generally recognize income when it's earned, cash method when it's received. For both methods, right, consider the idea of unearned income, that is to say receiving payment before providing the services. So under both methods, a couple things to be aware about, right? Prepaid rental income and unearned interest income, those are recognized, i.e. you have income upon receipt. So hey, you have a tenant, right, who comes in. They're like, look, I want to pay you 6 months in advance. I'm in December right now, and I'm going to pay you for December and the next 5 months of next year, right? You got to include all that income in your the current year, right? Because it's whenever you received it. Now, distinguish that from a security deposit, right? You're not going to claim income for a security deposit because you have like an equal and offsetting obligation to repay that, okay? So as we have here, and when we're talking going back to accrual basis taxpayers, they have to follow the full inclusion method for prepayments. That is to say, included in the year of receipt, not when they earn it. Okay? And what's going on here, right? So as I have, however, accrual basis taxpayers can depart from this rule, the deferral method. That is, they can defer recognition on unearned income until the tax year following the year of receipt. So what's going on here? The general rule is going to be full inclusion. They pay us in advance. The exception to this, right, will be the, in this case, the deferral method, right? They pay us in year one, but we get to kick the can into year two. The exception to the exception, though, says to the extent we earn it or we include it in the financial statements in year one, we got to account for it and record it and recognize it, right? So this is kind of what's going on here, right? General rule for prepayments, exception to the exception. So let's look at 917, give this some facts here. Okay, so in November, year two, we have a taxpayer. They receive $7,200 advance payment for work to be performed in the future. Okay, terms of the future performance are $300 in December, year one, through November, year two. Okay, so that green arrow, that's the work. That's like over the time we're going to do it. They want to know here, how much do we recognize in year one? All right, so one of the things with this is if we're an accrual method taxpayer, even though we got the money here, right, we can use the deferral method to punt it into next year, right? But the exception for this, if we use the deferral method, is to the extent we earn it in the current year, we have to include it, right? So what's going on here? So as I have an accrual method, they can elect deferral. However, to the extent they earned it in year one, the $300, they got to include that in year one. So hey, we got 7,200, 300 we got to include in year one because we earned that. The remaining 6,900 we can defer into next year. If we were cash method, right? Whenever we get all the cash, it's all the income. This one's just showing you an alternate version of it, right? This is just saying, hey, say we don't do any of the work in year one, right? They just give us the $7,200 and we're going to do all the work next year. Well, if we use the deferral method, we can defer it into next year. We didn't earn any in the current year. Okay, so that's what this is kind of saying here with unearned income for accrual method taxpayers. Let's talk a little bit about inventory, right? So just like with your financial accounting, you're going to have inventory on for tax. You need to account for it. You need to determine cost of goods sold. One of the things with inventory that's interesting is that you have this UNICAP rules. Right, and the UNICAP rules basically say, what do you capitalize as a product cost versus what do you expense as a period cost? Like, what do you kind of absorb into your inventory? You defer that expense until later on when you sell it for the cost of goods sold versus what can you immediately expense now? And they're very detailed, nuanced rules. They're a headache to comply with. You have to kind of go in and pluck out all the inventory. It's like a big headache to deal with this. Accordingly, because UNICAP is a headache, right, only large taxpayers are going to be subject to UNICAP, right? So we've seen that test for large taxpayers, hey, they're going to have to do and be subject to UNICAP. Likewise, we said they must use the accrual method, right? It's easier being a small guy here, right? Small guys are going to have a little bit easier stuff when they're doing their tax returns. Now, you can look at that with UNICAP. That's really kind of going about what I said there. What do you capitalize versus what do you expense? Likewise, do be aware that on the tax return, you can use, and there's options for FIFO, LIFO, specific ID. Obviously, right, like throwback to your financial accounting days, right, if costs are rising, costs are falling, you can sort of pick which one would make the most sense. I'm not going to give you some giant problem on the exam for FIFO, LIFO, and specific ID. I would know it exists, but that's kind of tested more like the actual calculation in a like financial accounting class. One thing to be aware of though is this LIFO rule. And this says you can only use LIFO for tax if you use LIFO for your books, right? They're not going to give you the best of both worlds, right? Kind of let you mix and match there. Hey, if you want to use LIFO for your tax return, then you must also use LIFO for your books and records, okay? So we talked about, accrual income, right? We talked a little bit about that. It's generally whenever you earn it. And then we talked about unearned income, right? We talked about the exception of that with the deferral method. Now let's talk about accrual taxpayers and expenses, right? So we said here, and as I have, right, to claim a deduction on the financial statement, you must incur the expense. To claim a deduction on the tax return, however, you must meet both the all events test for deductions and the economic performance test. And this is unless there's a recurring item exception. So you can see there's a lot of twists and turns to this. So let's kind of unpack this, right? We're talking about accrual deductions. We said the first thing you got to do is if you want to take a deduction is meet the all events test for deductions. This is similar to the test for income, right? All the events have had to have occurred. The liability has to be determinable, right? So if we look here at 921, right, on November 1st, the taxpayer agrees to a one-year contract with an advertising company. Per the contract, they're not going to pay the advertising company unless their sales increase by a fixed percentage. What amount can they deduct in year one? So, hey, we're trying to pay contract here with an advertising company, and it's a contingent amount that we're going to pay them. It's contingent on how much our revenues increase. Well, the idea for this is under accrual method, the liability here is conditioned. In other words, we don't know if we're going to pay this or not, if it's actually going to incur. So because it's not fixed, because it's not determinable, we do not meet, right, the all events test for deductions, right? We fail that, so we don't get the deduction. If it was cash, right, we didn't pay the cash, so you don't get it then. Okay, so that's kind of the first prong there. The second prong says, okay, on top of the all events test, you also have to meet this economic performance test, but there is an exception that we will see there. So it says the economics performance test for deductions was created because taxpayers would claim deductions, but only pay them later. And under the economic performance test, businesses may not recognize a deduction for an expense until the underlying activity generating the liability has occurred. So what's the upshot of this, right? Well, accrual basis taxpayers are generally going to be prohibited from deducting estimated expenses or revenues. Likewise, be aware that accrual basis taxpayers are not allowed to deduct prepaid business expenses, even if doing so qualifies under the 12-month rule, unless it also has met the economic performance test for the requirement. So let's look at this more specifically, right? The specific requirements of economic performance depend on how the liability was generated. All right, so we're saying an accrual method taxpayer, they want to take a deduction, right? We know we have to, 1, meet the all events, and 2, we have to meet the economic performance test. When do we meet the economic performance test? Well, it depends on what the scenario is, and we have 4 scenarios. Right, the first scenario, right, receiving goods or services. So the general rule here is whenever we receive goods or services from another, economic performance occurs for the expense associated with the liability only when the other person provides the goods or services. There is an exception here, right? If a business pays the person before the person provides the goods or services, businesses may treat the payment as economic performance if we expect the third party to provide the goods or services with 3.5 months after payment. So let's look here at 922. This will make more sense with numbers. Okay, so we're talking about, and it says per contract, a taxpayer pays a subcontractor a $1,000 down payment and will pay them $2,600 when the job is finished. Okay, the subcontractor doesn't start the job until year 2, and we expect the job to be completed in April of year 2. Okay, how much can the taxpayer deduct in year 1 and year 2, right? So it looks like here we pay them, they're not going to do it, complete the job until April of year 2. What can we do here? So if we're accrual method, right, we're not going to have a deduction in year 1 because there was no work performed. And if the job was completed in year 2, then $3,600 then, right, when the services are performed, right? So this is just showing the general rule here. You don't get the expense. Economic performance isn't meant until the guy does the work, right? And here, whenever they complete it, right, that's going to be in April, which is after 3.5 months from the year of payment, right? So this is showing this guy right here, right? You don't get the expense until the other person provides it. Here, right, they didn't provide it until year 2. We don't get it in year 2. Let's compare that with this, right? Same facts, except $900 of the contract, or it's a $900 contract, and we expect the guy to complete it within the first 3 months of year 2. So what's going on is we pay the guy here. We think he's going to get it done in the beginning of year 2. That is to say, less than 3.5 months from when we paid him. For this reason, right, we'll get to deduct all of it over here, right? That's when we'll get the deduction because we have the exception, right? So that's what's going on here. If we pay the person before he does the work, that's great. And we expect him to complete the services with 3.5 months, then we can do it now. We don't have to wait until he performs, okay? The next one here, use of property. This is the second situation. When a business enters into an agreement to use property from another person, a rental expense, lease expense, then economic performance occurs over the term of the lease. Let's look here at 923, 924. On May 1st, year 3, we prepaid $7,200 in rent. All right, 12 months at $600. How much can we deduct in year 1 if accrual method taxpayer? So this is very similar, right? Here we are in May, right? We prepay for the next year, our rent, the idea with this is we've accrued, right, 8 months of rent of $600. Right here we are at the end of the year, kind of like those AJEs. And what's going on here is the expense there will be $4,800. And I said, even though the prepaid meets the 12-month rule, as an accrued taxpayer, we can only deduct it when economic performance occurs. Okay, so it's like 12 months plus economic performance, right? We don't have economic performance here. You can see if it was cash method, right, you would get the 12-month rule. That economic performance test doesn't apply there. So that's a good way to distinguish those for kind of how that 12-month rule comes into play. You can look at this one here, right, for the rental. That's another one that could help you out. So we talked about 2 of the 4 scenarios. How about providing goods and services? So businesses liable, and really what we're talking about here are like payables, wage payable, liable for providing goods or services to the other persons, meets the economic performance as they provide the goods or services. So let's look at 925. In December, year 3, right? So we're like at the end of the year, right there we are. City hires a taxpayer to remove a fountain and begins work. It looks like the taxpayer accrues $850 for year 3 for the work that was performed in December, right? So during December, there was $850. And then they finish the job, right? So here's year 3, over here is year 4. They finish the job and accrue $650 for year 4 work. It says in year 4, taxpayer pays out the accrued expenses of $1,500. Right, so $850 plus the $650. How much can the taxpayer deduct for the project? Okay, so maybe we, in this case, right, we're that taxpayer, we're that construction company, we have our employees, right, our wage payable, the liability, right? We accrue, in this case, it's essentially just like an accrual basis, right? For year 3, we're going to get the $850 that we accrue it as our employees worked. For year 4, right, we're going to get it for the amount they worked. You could think of this just like accrual accounting, right? Like employees work for 3 months, right? Debit, wage expense, credit, wages payable, right? That's kind of a similar framework for timing and method here. And then 4 here, right, it says economics occurs for certain liabilities only when we actually pay it, right? So really it turns certain liabilities, they really make it cash basis. So example, workers' comp, rebates, refunds, right, insurance, warranties, right? The idea with these is you only get economic performance, therefore you can only deduct whenever you pay these guys, okay? So as I have here, right, we said with an accrual method taxpayer, right, they have to meet 2 tests, right? All events and economic performance. We talked about economic performance, the 4 situations. This says, hey, you do not need to meet economic performance if you have the recurring item exception. It's really trying to make it a little bit easier for people, right? You think about this, you're trying to do your tax return. This is a lot of rules, right? If we can kill one of these prongs, it'll make it a little bit easier, right? So the idea here is under the recurring item exception, accrual method taxpayers can deduct certain accrued expenses even if they don't meet economic performance, okay? And a recurring item is a liability that's expected to recur in future years. it's not material in amount, and deducting it would more properly match it with the revenue. So what are the examples here? Right, it would be things like insurance, rebate, customer refunds. Obviously, you still have to meet the all events test, right? That's still in play. But these guys, right, we can get them under kind of a different framework. So let's look at 926 here. All right, so it says a taxpayer offers a refund if a customer is unhappy with work. At the end of the year 3, we get refunds totaling $800. Hey, we had clients, they don't like our stuff, we want $800 back. Taxpayer 2 only pays the refunds in year 4. Okay, they want to know when can we deduct the refunds. So this is the general rule, and then we'll look at it if you want to apply the recurring item exception. So under the general rule, right, if it's accrual, we aren't actually going to get it until we pay, right, over here in year 4, right? And the idea for this is, right, this would be scenario 4. It's basically cash basis. You don't get refunds. You don't have economic performance until year 4, okay? So that's the idea there. You would get the expense in year 4. That's going to be the general rule, right? Where we got to meet both the prongs, the all events and the economic performance. But if, right, we wanted to apply the recurring item exception, right, that's going to basically kill that economic performance and let us take the expense here in year 3, not in year 4, right? So this is showing you, right, we meet the all events test, it's recurring, it's immaterial, it's going to occur within a reasonable time after year end, right? So it's just kind of showing you that setup. All right, bad debt expense. Let's talk a little bit about this, right? If you remember your financial accounting days, essentially you are going to, at the end of the period, use that allowance method, right? They have like the percentage of credit sales, the aging of receivables, where essentially you estimate the bad debt expense at the end of the period. And then later on in the next year or subsequent periods, you kind of reconcile it as it's going on. So it lets you take the expense in the period of sale. For tax, we don't do that, right? Tax, we use the direct write-off method. So what that says is, yeah, hey, in year 1, we make some sales on account, right? Debit, cash, or I'm sorry, no, we'll do debit, accounts receivable, right? It's not cash, it's receivable, credit, revenue, right? We don't, at the end of the period, like estimate how much of these we think the guys aren't going to pay us. Instead, we only take the bad debt expense if and only if and when the guy unequivocally conveys to us, hey, we're not paying that, right? It's like, imagine you were a bookie or something, right? And you had all these like sort of people who owed you money. You don't actually, for tax purposes, get to have that bad debt expense unless and until the guy's like, look, I'm not paying you. A couple other kind of limitations here. Be aware of that accrual method. Businesses generally can deduct compensation as the employee performs the services. However, not allowed to deduct compensation accrued at year end. So for example, year end bonus, unless they pay that compensation within 2.5 months of year end, right? So here we go, year end, we're giving you your year end bonus. Unless we pay it to you within 2.5 months, right? If we do it right within there, then we get the expense in year 1. If we pay it to you over here after that 2.5 month window, we only get the expense in year 2. Another kind of limitation on it, payments to related persons. The idea with this is they don't really want people gaming the system between related parties. All right, so we talked a little bit about before, whenever you have related parties, whenever one, let's just say father sells to son property, right? Just say it's a machine or something, or a house or a building, right? Some kind of business property. If father, when he calculates that, is at a loss, right? Amount realized minus adjusted basis, he does not get to use that loss, right? Because these are related parties. Son, later on, when son goes to sell it, he might be able to use father's disallowed loss. That's kind of the first setup with related parties. The next setup says this, right? Whenever you have an accrual method business, right? So you can have related parties between family members, and you can have them between like owners of a business, right? Like you in a business you 100% own are related parties. You can kind of manipulate things there because you own it, right? So when you have a business, right? Let's just say you have a C Corp, right? And it is accrual method. And they have an owner, right? Let's just say you, whose cash method, right? There's a kind of a mismatch there because they're using accrual and you're using cash. Your related parties, in order to prevent them from like abusing this with those kind of timing differences, they say, you, the corporation, right? We're talking about expenses, right? An accrual basis business. You don't get the expense for a liability owed to that related person. So maybe wages payable or something like that, until the related person recognizes the income associated with it, right? So, hey, you don't get wage expense and like wage payable, right? Unless and until you actually pay the guy, right? And he includes it in his income, right? So if you accrue it in year one and he only gets the income in year two, you don't get the expense until year two. This kind of prevents that timing manipulation. This just says, be aware, there are some kind of flexibility situations, differences between cash and accrual method. Generally, cash is going to be more flexible, right, for tax planning. But remember, those large taxpayers must use accrual. Right, so here's some kind of differences on there for it. You can look at that. Here's an example showing you. Finally, here, let's talk a little bit about adopting a method. So we've said, hey, you have your overall method, right, cash or accrual. Likewise, you're going to have specific accounting methods, right? Like how do you account for inventory? Do you use FIFO? Do you use LIFO? Right? So on and so forth. And generally, how you adopt these methods is using them, right? And the idea with this is if you're using a permissible method that you're like, okay, you are allowed to do this, you adopt it by using it for 1 year. If, however, it's an impermissible method, you adopt it by using it for 2 years, okay? And say that you want to change accounting methods, right? You want to go from maybe FIFO to LIFO, or you want to be a cash method taxpayer and change to an accrual method taxpayer. Well, generally, you can't do this like, willy-nilly. You have to get permission from the IRS to change your accounting method, right? You got to fill out this form 3115, basically giving like a reason why you're doing it, like a legitimate business purpose to justify it. And essentially what they have you do here is you have to look and kind of run some numbers on it when you make a change, right? You change from one method to another method, right? What they say is you have to make an adjustment to taxable income, a 481 adjustment, that represents, as of the beginning of the year, the cumulative difference between the amount of income or deductions recognized under the old method and the amount of income that would have been recognized for all prior years if the new method had been applied during those years. So you basically compare all that time you did the old method, right? What would have been your income? What would have been your deductions with, right? So you compare what you did with so like your old method with what you would have done under the new method, right? You kind of compare that. And basically, whenever you do that, one of two things can happen. It's going to produce an adjustment, right? This 481 adjustment. If that adjustment increases taxable income, then you'll recognize it evenly over 4 years, beginning in the year of change. If it decreases taxable income, then you recognize it entirely in the year of change. So let's look here at 930, right? This will give us some facts on it. Okay, so let's say taxpayer makes a 481 adjustment to switch from cash to accrual. So we got to compare all those prior years we did cash with what if we had done accrual during those years. And essentially what they're saying here is, hey, when we compare that, we would have had accounts receivable of 24,000, right? Kind of income there, more sort of sales on account. This results in a positive adjustment, 24,000, right? So because it's positive, we recognize that over 4 years, which that means is we're going to recognize $6,000 a year in our taxable income for the next 4 years. So they'll let you spread it out a little bit, right? That income. If we change the facts and it was a payable, right, $4,000, this is a negative adjustment, and we're going to include that in full in the year of change, right? So you get the whole thing there. So with that, I'm going to kind of pause and end the lecture here. This is one of those things, there's a lot of twists and turns. You got to read it carefully. Look at the class notes. Look at the problems. It's not something you're going to hear once and now magically you're an expert on. But with that, I'm going to end class here.